Property prices in Sydney and Melbourne are starting for the first time in quite a while to decline, and in today's video I'm going to explore why these property prices in Sydney and Melbourne are declining, and in fact we're going to break it down to the short-term and long-term performance of those markets. I'm going to talk a little bit about the media and its effect on sentiment down there right now, as well as how the banking inquiry, as well as banking's constriction on the Australian investor market in particular over the last couple of years is playing out and having an effect on this, as well as my belief that this is a completely natural correction, as well as at the end of the video describe exactly how long this is going to last for and how far I believe prices are going to drop down there. Now, this isn't Ben Everingham's opinion from Pumped On Property. This is just data that I've collected from lots of different people in the industry and me presenting that data back to you. So let's get into it. Now, the first thing and most important thing that I wanted to say is that it is completely natural for a market to go through cycles. Now, sometimes a market goes through a cycle, sometimes a country goes through a cycle, sometimes the world goes through cycles, and at different stages if you understand timing. And for those of you who are interested in learning more about this, you can check out Fred Harrison's two books, one being The Secret in the Land, the second being Boom or Bust, as well as Phil Anderson's book, The Secret Life of Real Estate and Banking. And in those books, you'll discover that there are natural ebbs and flows, both locally and globally, which have a long-term effect on when to buy, what to buy, and what's happening in the marketplace, and may give you a lot of comfort knowing that we aren't near a global GFC type event or a Great Depression style event. As much as the media down there is hyping it up at the moment, the prices are going to fall through the roof, it is not going to happen. What has happened is that we've had a huge period of speculation in Sydney and Melbourne since the GFC that was driven by easy, cheap money, by local investors, by owner-occupiers, by first-timers, by people like me and you that have got in there and got stuck in and driven prices up. We've had huge population growth pressures. We've had two markets that were completely undersupplied from a property perspective, and we've just had an artificial pumping of those two markets for a period of time. And what that has caused over a 7-year period is those markets to grow by between 70 to 100% in some instances with some properties in some suburbs. And what is now happening is what always happens once we go through such a strong period of growth, and that is the people that bought at the very top, which we call the winner's curse, are now feeling the effect of a small drop in prices. Now, the underlying demand is still there. The underlying pressure in those markets is still there. The reason for this isn't because the Australian economy is in a dire position or the global economy is in a dire position right now. It is just that the banks and the Australian government realise that these markets were probably over leveraged and artificially heating up and creating potentially a bubble if this had have gone on for another couple of years. And they said, we're going to stop pumping money and we're going to stop priming those markets, and we're going to pull back the ability for people to get finance. And that is what has slowly put the brakes on those markets over time. And now we're seeing the full effect of that. Now, property prices, could, if you look at the long enough history of Australia or America or Europe in this sort of middle of the cycle that we're in stage right now, could potentially pull back by 5%, which they have in Sydney. In some instances with some types of property, it could pull back quite a bit further than that. But we're talking about people that have bought in the last 12 months, that have paid an absolute premium, that haven't put down big deposits, that are the ones that are exposed to that, as opposed to people that bought in 2, 3, 4, 5 years ago, that have got good equity in the property now and have good cash flow if it was an investment. So it is completely normal for this to happen. Stop buying the hype, stop freaking out. The whole world's not going to fall over. We've still got 400,000 people in the last 12 months that moved to Australia. Over 100,000 of them wanted to come and live in Sydney with you or Melbourne with you. We have a complete undersupply of the type of product that people really want to be living in down there. Yes, it is bloody unaffordable. That's probably going to mean that prices come back for a little while. Then they will sit stable for a period of time until they're affordable for people to buy again. But in terms of these doomsday callers that are saying a 50% drop in prices, turn that shit off. These people have a vested interest in saying that stuff. And I'm not saying you should go out and buy property in Sydney or Melbourne right now. I feel like that opportunity has long passed. It's time to start getting your head around different markets like Southeast Queensland and Brisbane, the Sunshine Coast and Gold Coast, that have great infrastructure growth, that have some amazing projects that are producing or are giving the people up here the ability to earn really, really good money with great potential and prospects for the future in terms of population. So, you know, it doesn't necessarily mean that all of Australia is in the same position that Sydney and Melbourne are right now. In fact, Brisbane has grown by less than 1% per year for the last 10 years, which, if you know your history, prior to the last 7 years, Sydney did exactly the same thing. It grew by less than 1% per annum for 9 years before the last spike. And you know, that leads me on to the longer term performance of these markets. Now, Sydney has always, you know, been coined Australia's top performing marketplace. But if you actually know your history, according to CoreLogic as well as the Australian Bureau of Statistics data, and look at it over a 20-year period, Sydney has performed the best, growing by about 8.8% per annum, but Brisbane and Melbourne have performed almost as well, growing by 8.7% per annum over the same period. If we go back the last 46 years and look at year-on-year data, up until the end of 2016, we can see that Brisbane has actually been Australia's top performing market over the last 46 years, growing by 9.7% per year, where Sydney and Melbourne over the same period have grown by between 9.5 and 9.6%. So yes, over the last 50 years, property prices have gone up and down and sideways and flat, and this is completely normal. So stop freaking yourself out about what's going on Today Tonight or whatever in the media, and start focusing on what you can control. Yes, you probably missed the boat in Sydney and Melbourne a little bit for now. Yes, those property prices may come down a little bit, but there are other markets that you can start to learn about, wrap your head around, and hopefully get good gains over the next 7 to 15 years in if you're buying the right type of product. Now, let's talk about short-term performance in the Sydney and Melbourne markets and why this correction is occurring. Now, Sydney and Melbourne have achieved exceptional growth, like mind-blowing growth over the last 6 years. And that is generally the result, if you know your history, after a GFC or after a recession in most countries around the world, to get the economy working again. Governments around the world make money very, very, very cheap. And then they incentivize people to start doing stuff with that money, whether it's buying stuff, whether it's starting businesses, whether it's buying investment property. And if you look at the big cities around the world, most of those markets have gone through somewhere between 30 and 100% growth over the last 7 years. Now, Sydney and Melbourne aren't the only places in the world right now that have gone through crazy growth, that aren't having a settling period right now. It is completely natural for those markets to perform very well out of a GFC to go through that. Some of that will occur over the next couple of years in different countries. Some of that's been occurring for the last couple of years. Sydney and Melbourne are absolutely no different. It is mainly the people that bought since 2016 in Sydney and Melbourne that are really going to feel the short-term effect of this temporary price reduction, or maybe stabilization or period of flatness, where, you know, if you came in and paid 50 grand more for the property than you should have, and you paid $1,050,000 or $1,100,000 for a property that really should have been only worth $950K, but you got caught on the bandwagon and the speculation and the fear of missing out and all of the things that made people buy in Sydney and Melbourne over the last year and a half, then, you know, hold through this period. As long as you're not forced to sell, you should be okay long term, because remember, it wasn't that long ago in Sydney. In fact, my grandparents were able to buy property on the northern beaches, walking distance to the water, for $2,000. It was less than 25 years ago that my parents were able to buy houses on the south side of Sydney for under 100K. So $1 million feels very, very expensive right now. Like $100,000 felt very, very expensive back then, and I'm sure $2,000 to $4,000 felt the same way when people were earning $1 an hour. But the reality is, over time, as money grows in value, as wages increase, as prices stabilize, Sydney and Melbourne will become amazing buying opportunities again. They'll become affordable again. I have absolutely no doubt that over the long term, next 15 to 30 years, you can expect relatively good performance out of Sydney, Melbourne, Brisbane, and Australian property. You know, if we look at the history, it's done so well. Even if we halve that history and go, you know, what does a 4 or a 5% gain on $1 million property over the next 30 years with good times and bad times look like? You're talking about being in a fantastic position long term as a result of that. So don't stress out with what's going on right now. Now, let's talk about the media and the effect that that's having right now on Australian sentiment in general. The news for the last probably 12, maybe even 16 months has been really, really bad, with lots of people coming out and saying that the world is going to fall on its head, that Australian property prices, or particularly Sydney and Melbourne property prices, are very, very overvalued, and you can expect the correction that, you know, we're now having. And I think it's beautiful that we are having a correction in prices in those particular markets, because it wasn't sustainable what was going on there and something had to happen. But what you've got to be able to do is pick the truth in the media. What is the agenda for those particular stories continuing to get as much airtime as possible? It is because they're continuing to sell ad space on TV and in the newspapers and online. So you've got to be aware that everything is great. The story of those property markets in the Australian property market doing so well for so long stopped having an impact, and the media's got to change the attention and the focus. And, you know, not just that, but the government had to step in, or the Reserve Bank of Australia had to step in and do something to stabilise those markets and stop people speculating, because we would have had a much, much, much bigger problem than, you know, a 5 to 10, maybe worst case scenario, 15% decline in prices there. But what you've got to do as an investor is go, that's cool, that's my Sydney and Melbourne basket. That's going to have a short-term impact on other markets in Australia, but sooner or later people are going to realise that the amount of infrastructure, job growth, population growth occurring in southeast Queensland, and the fact that that market has been dead, literally dead for 10 years now, and there's all of these people in Sydney and Melbourne that can't afford to live there anymore, moving up here with good jobs, with good incomes, with good cash in the bank or equity from a property down there. And that is going to slowly change the story around what is occurring up here, and over time property prices are going to benefit as a result of that, like they always have in the past. So remember, your short-term history is not a true reflection on long-term history. Don't sit on your hands like a lot of people are going to do over the next 12 months until the media changes the story, and start getting your head around other opportunities in Australia, which I truly believe that there are some incredible options up here at the moment. Now, one of the major reasons why property prices, or probably the major reason why property prices have stabilized and in some areas started to decline at the moment, is money is much, much more difficult than it was to get 12, 18, 24 months ago. And that is a very, very deliberate play from APRA, which I personally love and think was the right step in the right direction to slow down the Sydney and Melbourne markets. It's also naturally going to have a knock-on effect to some of the other marketplaces around Australia in the short term, because people follow the herd and they can't differentiate one market from another. But over time, that monetary policy will relax slightly. Money is very, very difficult to get right now for some people. If you're a first-time buyer, it is as easy as it's ever been to buy. If you've got good equity and a good combined income, it's as easy as it was ever to buy. But if you've got huge amounts of debt or a really large number of properties, then it can be a little bit more challenging to buy. So 80% of the market, which is the Australians that own 0 to 2 properties, are completely sweet right now. It is just that 20% of the marketplace that are finding it a little bit more difficult to get access to that finance. And that's cool, because a lot of those people were the ones that were speculating really, really heavily. And, you know, some of those, you know, international monetary policies where it was easy to get access to finance and buy property in Australia have also now been curbed, which is slowing down that international demand for Australian property too. So it's completely natural. Like real estate, goes in cycles. Sometimes it's going up dramatically, sometimes it's on a slow increase, sometimes it's flat, sometimes it declines, and sometimes that decline is very rapid. But it is natural for money to do the same thing. Sometimes it's easy to get access to money, sometimes it's very, very difficult to get access to money. All of these reasons for the money to contract a little bit in Australia, I think, are completely valid and have had the right effect on the Sydney and Melbourne markets to slow the growth. Your job now is to not get caught in the hype that so many people are right now in those marketplaces, and to start educating yourself, you know, now, so that 3 to 5 years or 7 years time from now, you're not looking at the Southeast Queensland market like you are probably thinking about the Sydney market right now, which is, I wish I had have been able to buy a couple of properties or a property 7 years ago in Sydney or Melbourne, and looking back with, you know, that regret that I feel most investors will feel, or people that were in the market like myself are very, very grateful for what's occurred. So two of the last things that I wanted to touch on is just this natural correction. Now, as we go through these cycles, these things happen. It is completely normal. It's completely natural. You've got to realize that I don't personally believe property prices, based on Phil Anderson and Fred Harrison's books I mentioned before, as well as, you know, where the Australian banks are at the moment, and where the Australian economy is at, and where the global cycle is in terms of its timing at the moment, is going to have a major, major, major impact on Australian property prices. And worst case scenario, it did have that sort of effect on Sydney and Melbourne, and prices there dropped by, let's call it 15 to 20% over the next couple of years. It's going to have a negative effect on sentiment, because nobody likes to lose money, but it is also going to have a great benefit to, you know, affordability down there, which will kick off the second half of the cycle in those areas, and also a positive effect as people exit those cities en masse to move to a more affordable location around Australia as well. Now, in terms of how long this is going to last, it really depends on two things, I think. Maybe three things. The first is how long APRA and the Reserve Bank of Australia continue to make money cheap to access but hard to get. The second thing, I think, is really around how long this negative approach to Australian property lasts in the media, and how many people get affected by that. Obviously, you and I aren't silly enough to get caught up in the hype, but a lot of other people are, and so it's about how long that is going to last. And then the third thing, I suppose, is overlaying the bigger picture global cycle, and just making sure you keep a finger on the pulse of those, you know, larger macro style events that, you know, do have an effect on sentiment as well. So, you know, how long it lasts is how long is a grain of string. In the past, in 2012, this has sort of lasted for 6, 12, 18 months. In previous GFCs or depressions, you know, price declines have lasted for a little bit longer than that. I think we're more towards the mid-cycle phase of all of this, where property prices can correct for a period of time and then potentially come back strong. I'm not saying they're going to come back in a very strong way in the next 7 years in Sydney or Melbourne, because the prices are very expensive, but other markets like Southeast Queensland, Sunshine Coast, Brisbane and Gold Coast, I believe will perform extremely well. If you look at their history, you'll be able to see that as well over the same period of time. So it's just, you know, over the last 7 years, you probably would have been investing in Sydney and Melbourne. If you knew what you were doing over the next 7 years, you'd probably be investing in Southeast Queensland if you were really looking into your short to medium term results, as well as a market that historically has performed very well. In terms of how far these prices can drop, you know, at the moment Sydney's at 5%, I think Melbourne's at somewhere between 1 and 3%, depending on whose data you're looking at. You know, prices on the very expensive end of town could drop 20% by the time this is all happened. It really depends on what product you bought. In other instances, you know, prices may only drop by 5 or 10%, which is completely natural. You've got to remember that if you've made 80 to 100% in the last 7 years and prices drop by 10% of that, you're still in an exceptional financial position if you bought a while back. It's really just the people that get in that winner's curse phase when they're scared of missing out in the last year before prices start to moderate and go flat or decline a little bit that really get caught out. So I hope you feel a little bit better from watching this. You know, everybody's got an opinion in this space. You know, don't buy my hype, don't buy anyone else's hype. Your job is to pick the little pieces of information in the market from people that have a history of performance and have a history of understanding cycles in a meaningful way, and that have got good results in good time and bad times, and, you know, to take that on board. All I'm trying to do in this video is offer a different perspective to, you know, what you're being sold every single day at the moment in the Sydney telly and on the TV. And, you know, I might be right, I might be wrong. I don't think it's going to be anywhere near as bad as a lot of people predict. And I also believe that, you know, it is irrelevant what happens in the short term with any property that you buy. Yes, it's nice when you make 20, 50, 100 grand in a 12-month period, but that isn't the norm in property. What you should be investing for, if you're smart, is the long term. You should be buying at the right times in the right markets and realizing that it isn't just Sydney and Melbourne that represent value. If you look at your long-term history, Brisbane, Southeast Queensland also look great. So thank you for your time and attention, and good luck with everything you're planning on doing. I hope that 7 years from today, this video is what sparked you starting to open up your mind and realizing that, one, things that aren't as bad as you might believe them to be right now. Two, that there are markets that represent incredible value. It's just up to you to start getting your head around them. So thanks for your time and attention, and good luck investing.